Jason.
And we're from Gao Capital. Today, we're going to talk a little bit about the impact of the recent tech correction on our fund, if any. So, as everyone knows,
The big tech in China sold off with a drawdown of almost 50% in Baidu year to date. So, Chauwei, we have a Chinese fund, Chauwei.
Yes,
Is it
the cat
affected
fund.
by this big tech sell-off?
And so, for those of you who don't know, our CAP fund is long equities for China. And so naturally, a number of investors called to ask like, hey, are you guys affected by this correction? And fortunately, we are not correlated to China big tech. So despite the sell-off, actually the fund is up a little bit. Maybe it corrected a little bit, and then month to date it's actually up.
Yeah, in the past 2 months, we're actually up, whereas tech has drawn down for about 15% on average.
So people ask, how is that possible, right? Since you're long China and then China is down. So
yeah, it's possible because we are a quant fund that invests in a diversified stock portfolio of over 100 stocks. So our positions in every stock is less than 1%. So actually we get the same exposure to China, but with in a safer manner, in a more diversified manner than big tech.
And the next question would be, if you're so diversified, then you'll be performing just like the index, and how are you getting excess returns of over 20% every year? We'll talk about the market inefficiencies in China.
Yeah, so the China A shares, which is what our cap fund invests in, actually benefits from the market inefficiencies available or present due to the high retail presence in China A shares. So securities are often mispriced because they experience low sell side coverage, and actually retail investors are just less value driven and more sentiment driven. So they invest in stocks without thinking as much as institutional investors. So that allows active value pickers like the cap fund to benefit from this and invest in mispriced securities.
So how does a quant strategy benefit from this, right? So if you think of how retail investors trade, they're driven by what's in the news. When something goes up, they're like, okay, let's pound more. Whereas computer has no sentiment, I guess it has no emotions. So it's able to say that, okay, it has gone up too far, it will come back down, or if a certain stock is like selling off too much, it should come back out. And so the increase in volatility due to high retail participation leads it to be a very fertile ground for quant investing, which is how we invest. So from my experience being almost 20 years in the market, I feel that this situation in China is similar to what had happened in the US maybe 15-20 years ago, when quant strategies made quite a lot of money. But then clearly now the market has become a lot more efficient, a lot more participants in the market, especially because the US and European market are I guess mainly English driven, so people can find a lot of news on it, and so it's very hard to carve out an edge in it, which has led to many quant traders going into things like machine learning, NLP, to try to get a little bit of an edge. Whereas in China, because of the inefficiencies, the language barriers, and I guess the generally younger market, people are still able to use more traditional techniques and able to get outsized excess returns. Okay, so we come to the third point of why people should invest in the CAP fund.
Yeah, and so in a more broader sense, why should someone invest in China A shares? It's because historically, in the past decade, it has a very low correlation with global equity. I think it's about 0.2 of a correlation with global equity. So it's good to have some exposure to China in your portfolio, as it allows for greater portfolio diversification.
Yeah, and this low correlation comes from the decoupling among the different countries and economies as to how localized and domestic markets behave.
Yeah, and despite China growing so much, it is still a growing Chinese market. And it's not only growing as an economy, but the stock exchange is actually still growing. So the Shanghai Hong Kong Stock Exchange, the Stock Connect, actually allows investors to access China A shares, which was previously closed off. And China A shares are now included in the MSCI indices. So this actually is a very positive signal for China A shares as more institutional and overseas investors pile into China A shares.
Okay, and last but not least, why we should invest in the China A shares market by us is because the team is effectively bilingual, and what we hear from a lot of brokers and even managers on the ground is that a lot of allocators or portfolio managers are not effectively bilingual, and which could lead to the inability to capture market opportunities. Okay, so that's it for today, and if you have any further questions about the fund or the China strategy or anything, you can contact us.
Yeah, give us an email or a call.
Okay, bye!
Thank you.